This is my stock market interpretation. Hi, my name is Patrick Bass. I want to explain my background a little bit. I graduated from CSUN with a bachelor's degree in business management. And then I went to get my master's degree in education. But going back to my business degree, after I graduated, I went to work with the stock market in San Francisco area. And I'm going to explain a little bit of background about that. The stock market actually started a long time ago in America, in New York City, in coffee houses. Different coffee houses sold different kinds of coffee beans, so they would trade with each other, and that was back in the 1700s. And that was in the New York area, and that eventually expanded, and it became called the NYCE, which is New York City Exchange. And that went on for a long time, for about 200 years. People started putting a lot of money into it. Like $34 million. It was a lot of money. So the NYCE started expanding a lot and growing, so a lot of people wanted to put their money in it. And another example is like the Apple company. You know, they have computers, they made the iPhone and the iPad. So they're involved with the stock market too. IBM is another company. They also make computers, and they started in the New York City Exchange for the stock market. The stock market is important. If someone buys a stock, they feel like they own part of the company. So if they have a share in the company, they feel that they have a right. They feel they have a right to be involved with the company, and they want the company to grow. So once they can buy however much stock they want, $100 share or whatever, and then they feel like they own part of the company. So then if somebody else has $100 worth of stock in another company, they can exchange it. They have something like that in Chicago that's the same idea as the NYC Exchange. There's also another new one sprouting up in New York, a smaller one. So I'm going to explain now why the stock market is important. Stock market is important. Basically, it's supply and demand. Costs go up and down and up and down, and there's a reason for that. So if the supply goes up, they're selling a lot, and the demand is how much is being bought. So the demand is more than the supply. So if the demand is more than the supply, then the supply must go up to meet the demand. So if the demand is stronger, then the supply typically tends to grow. But then if the supply gets stronger, but there's less of a demand, then it starts going down. With stock market, it's important to understand the basics of supply and demand. There are lots of big people, businessmen that like to invest a lot of money in the stock market. So if they invest a lot of money in the stock market, if the demand goes down, then they're not getting as much money's worth. So typically when you're investing, you can either put a whole lot of money into one company, or you can put some money into a bunch of different companies, and that lessens the risk factor of losing all your money. So if one company goes down, you still have investments in other companies. But if you put all your money in one company, that's a huge risk, because if that company goes down, then you could lose all your money. So then when you're trying to make investments, you write a check, and then you give that check to your the person helping you make the investments in the stock market. So now we're going to talk about why it's important to invest in the stock market. For example, if IBM has a problem with the computers, they break down or something, people are worried, what am I going to do if all their computers stop working? This information is going to spread to the public, and they're going to be really scared. And then the demand is going to go down because people would be worried about that product. But when you're putting investing in the stock market, it's important to have a professional helping you out because they know the risks and the benefits and how to control your money. But you have to make sure you trust the person that you're investing money with. And if you do have a worry, you can call that person or communicate with them somehow, email, and discuss with them the problem and their opinions on it. In order for the money to grow, it needs to be traded around in the stock market. And I'm going to use Apple and IBM as an example. So, for example, if you invest $10 over 3 months, 6 months, 9 months, so on and so forth, that money will grow. There is risk involved, yes. Which is why diversion is important, which is spreading out your money in stocks in different companies. That creates a low risk factor. Whereas, as opposed to if you put a whole bunch of money, say $100 into one company, the risk factor is higher because it may not grow as quickly in each place. So if the money that you have diverse in, that you have put in different stock markets may grow, or in different companies may grow up to as much as 30%, whereas the companies you have more money in may only grow as much as 2% every couple months. Apple is a very popular company right now. Oh, I'm going to back up a little bit. Facebook was privately owned for a long time. It wasn't public, so people couldn't put stocks in it. So there was big discussions about whether or not it was going to become public. For example, if Facebook has 400,000 shares split between different people, there's how are you going to split that is the question. There was quite a debate as to whether or not it would become public because of the way the money would be split up. So the cost of each share would be about $10. So in May, when it became public, people were so excited. There was a big hype about it, and they wanted to buy and own own parts of Facebook. So people were buying like crazy. So the supply was low, but the demand was high. So they needed to create more supply for the demand. And they can't sell it, they have to hold on to it for a year. Now we'll go back to the Apple company. It was created by two men, Steve Jobs and a co-worker of his. It was started back around in the 1980s. Back then, the shares were about $16. And they were so inexpensive because people had never heard of Apple before, so they didn't know if it was a good or a bad company. So now Apple today is obviously a great company, and shares are now $633, so obviously it's grown a lot. It's become very popular because it has computers and the iPod and iPad, and Apple became a very exciting company, so a lot of people wanted to buy shares for it. Maybe in the future they'll create more iPhones, or they might have TVs in the future from their company. So I've heard that shares will eventually grow up to maybe $800 or $900 for Apple. It's kind of fun to invest in the stock market and own part of a company and see how much it'll grow. The stock market is fun, but it definitely is a risk, so it's important to know that. So it's good to look into it and see what kind of investments you may want to make. And do some research to know which companies you'd want to invest in, and meet with somebody who can maybe suggest to you how much to invest and where to invest. So yeah, investing in the stock market can be fun.